webinar. I am Sneha and I'm currently interning with Finance Skill under Dr. Devadatta Das. And I'm delighted to welcome you all to today's webinar on Achieve Financial Independence and Retire Early, the FIRE Blueprint. At Finance Skill, our mission is to make high quality financial education accessible, practical, and impactful. Today's session is designed to give you not just theories, but actionable strategies that can help you move closer to financial freedom. We are honored to have Dr. Devadatta Das with us, Associate Professor of Finance and Accounting with over 20 years of teaching, consulting, and research experience. Dr. Das has worked extensively with the BSc, NSc, government projects, and top institutions like IIM Bangalore. He is also the founder of BISFA Future Securities and the Das Educational Trust. In this 1 hour session, Dr. Das will guide us through the core concepts of the FIRE movement, the right investment mindset, and practical steps to plan for early retirement. By the end, you'll have a clearer idea of how to set your own financial independence goals. So, without taking much time, we'll get to the point. So, let's start. Sir.
Thank you. Thank you, Sneha. I hope that I'm audible properly, right? And let me welcome to all the participants and thank you so much. You have, taken some time, particularly in Sunday, to attend this webinar. And I hope that, at the end of the webinar, you will not be disappointed, basically, and you will get something with my expertise or maybe whatever I have planned to share with you. So let me just before starting, let me tell you basically this type of this webinar is a series of financial literacy. That means it's nothing. I mean, we don't have any commercial or any purpose. So basically, to educate people that know what they have to do, what they don't have to do. Okay, so let me just start sharing my screen. So let us start this webinar with this point that what is FIRE. So this is a word which usually it's a buzzword in US, which is usually originated there among the millennials. The philosophy is nothing that means you need to save aggressively, invest wisely, and retire early. So now you guys might be thinking that what happens? We don't have a job and you are talking about retirement. And the answer is yes. This is the right moment. Actually, you need to think about investment. I mean, retirement is just a word. I mean, you just don't take it that much into this picture. But look at what happened actually. Where if you are not creating wealth in your entire career or entire life, at a point of time when you realize that you are in a shortage of wealth, then probably you might not have time neither to earn or neither to accumulate. It will be very difficult situation. So that's the reason why you need to start everything early. So that's why this message is pretty clear. Even though I mean you people, most of you are yet to ready to go to the job market. So this is the right time. You need to understand about finance, about investment, what is right and what is wrong. Let us start it. I mean, this FIRE is actually, there are many variants of FIRE. Just I will give you a little bit hints about what these words basically. But our webinar, the purpose is that, to the deeper, to get the real of the investment. So one of the very popular variant of FIRE is called lean FIRE, where usually people they choose a minimum lifestyle. They usually sacrifice a lot on their aspiration, or you can say that they reduce their cost, they save more. That's why lean fire. So fat fire is a different kind of another story. You can say that people they start with luxury life, like those who are even going to the job market little early, so they will start, spending much. But here, what happened? Luxury retirement. That means also they need to earn that much. That means you need to earn more. You need to spend more, which is usually lean fire. It depends that actually whatever you are earning, so you have to minimize your expenses so that your savings will increase and you can have a good retirement fund or maybe you can accumulate a good wealth. Whereas barista fire is usually we use this word where you just continue. I mean, even after retirement, also you start continue with some part-time job or maybe some other. You depend on certain active income still. I mean, even though you retire after a certain age. Whereas Coast Fire is talking about that retirement with minimal contribution. That means usually what you do in Coast Fire, you contribute a minimum to the savings, and finally you just it will accumulate with a very early stage. You do that, and then it will accumulate, and you will have a retirement profit. So these are all very thin lines, and ultimately the goal is that how to accumulate wealth, and basically you can have a peaceful life. So now the question is, because as I said that this is a kind of buzzword in US. So is fire possible in India? Okay, that's a big question. So I mean, look at India is not far behind. India is growing, and we will discuss. I mean everything in a very short while, particularly about the economic perspective, how India is going, and how India is growing. So particularly, these are the characteristics. Right now, we just observed that growing middle class. I mean, usually our populations has been you can say that middle class uh, contribute a larger amount of populations. So those middle class population is growing, and they have a higher aspirations. They have a higher desire. They have a higher aspirations. Then the next point is that rising inflation and cost of living challenges. I mean, all of us we are facing the similar kind of challenges. Just a day before, yesterday, most of you, I mean, ACCA students are there. One student was, telling, sir, the fees was $140 last year, right? I mean, sorry, £140 for applying one paper examinations. But what happened? I was paying around 13 to 14,000 rupees last year, but suddenly that amount has increased, and this time I have to pay around 20,000 rupees. Look at what is the point actually. There are a lot of things which is inside, right? Our rupee value is the depreciating. That means, of course, there are other factors are there, but let us talk about the rupee value is depreciating. We have inflation. We have cost of living challenges. We have cost of living. You can say that education cost will increase, healthcare cost will increase, your life insurance cost will increase. I mean, things are going to increase, right? So accordingly, if you don't plan, so definitely it will be a big challenge for you to manage this. But what are the opportunities? Yes, we have opportunities which you can say mitigate those kind of problems like rising inflation and cost of living challenges. You may counter it through SIPs, mutual funds, stocks, right? So these are a lot of investment opportunities are there, options are there. Then also we have very secured options like PPF. PPF is nothing. This is a public provident fund, which is meant for everyone. Let me just quickly tell you how PPF is one of the best you can say investment option for all of you. It is a public provident fund. It is meant for everyone. I mean, usually most another popular kind of provident fund is called EPF, Employees Provident Fund. Usually, if you are working in an organization, so organization will provide that facility. But PPF is for all. Even if you are doing business, you can also invest in PPF. This is one of the flagship government investment option. I mean, a lot of benefits are there. I mean, you can say the pros are there in PPF. NPS, which is not very old, but it's also a good investment instrument. Then EPF, if you are working in an organization, so definitely you should opt EPF for retirement. Then what else? We also have real estate and digital assets. Digital assets means like we have cryptocurrencies, right? NFTs, all sort of things. We will discuss a little bit about that. And also we have cultural factors like family responsibilities, lifestyle choices, all sort of things are there. So let me just take a poll, and probably we will move to this slide. I hope that all of you can see the poll, right? Yeah, just choose whatever you want. Very good. Wonderful. Okay, so I think another 2 seconds is left. All right. Let us see that. I mean, what is our respondents respond to at least? I hope that all of you can see the poll result, right? So, I mean, basically, retiring early and living stress free. Okay. Uh, One student has given this option. Having enough passive income to cover expenses. Wonderful. Not depending on a job for survival. That is also a good answer. Achieving a target of wealth, like, 1 crore. Many of you have given this, freedom to pursue passions without financial gain. That's absolutely a brilliant answer, I will say. Uh, I mean, if you are, financially free, I mean, the freedom is there, so probably you can pursue your passions, even though little late. I mean, you can do that. That's pretty interesting. So, if we see that why this financial independence matters for us, is it really required? Yes. So first of all, that escape from paycheck to paycheck cycle. That means when you start, working, so every time you need to depend on, paycheck to paycheck when the salary will come, when the salary will come. It should go out of your mind so that, I mean, financial freedom has a lot of advantage. You will gain your health. I mean, wealth actually is nothing. I mean, if you have a good health, that is what your overall wealth, nothing else. In your life, there is not, bigger or much bigger, wealth other than your health. And if you have tension or if you have some worriedness about finance, so definitely that could be a obstacle. So that kind of, things we can escape from paycheck to paycheck cycle. Then freedom to pursue passions and side ventures, which most of our participants they just now they shared their, views that yes, they can pursue their passions and side ventures. If somebody had desired that to start an entrepreneurship or a business or to do something, travel or maybe some other kind of, things, so that could be the right time to pursue. Security against job loss. That is always, it worried us that we can lose our job at any point of time. Of course, inflation, what we just discussed about, that increase in the price of goods or services, and also, I mean, not to forget about the emergency, sudden requirement of sometimes you may require some emergencies and you don't have funds, so you don't have another choice. Either you can beg to your friend or family members, and if you're not getting there, you may approach to the bank loans. And we usually remember that financial institutions, they never approach you when you have a need. It's a very tough situation actually, in the practical situation, that when you require and you go and you approach the financial institutions like banks or any other financial institutions, so probably you may get disappointed. So how to overcome this kind of situations, how to avoid those situations? Of course, you need a financial independence. And of course, then another point is that peace of mind and work-life balance, which is very, very important. That you should have a peace of mind because you are not thinking about money, no more, because it is already automated. You have automated the system, and it is taking care of your whatever your day-to-day expenses, or maybe whatever, I mean, even larger goals or something, it is being taken care. So that peace of mind and work-life balance will help you a lot. And when you do an early retirement, that means you can spend more time with family, you will have a good health, and of course, you can focus on your hobbies. So today in this webinar, what we're going to learn that, what are the macroeconomic scenarios. Let us understand about finance a little bit. What is happening around us, particularly what Donald Trump is thinking. So we will, pick a little bit about it. And then we will discuss about what are the investment instruments, what are the options in front of us, where we can invest. That also we will learn. And also we will talk about risk versus return. So how they are correlated. And we will learn about model. We will design a model. All of us we will learn that how to develop this financial model, personal financial model, and we will plan for 1 crore goal. That if we can have a corpus of 1 crore, so probably it could have a better, we can say, a plan. Then also we will learn about how to create wealth, what are the wealth creation opportunities and retirement planning. And finally, we will talk about, I mean, we can have question and answer sessions. But guys, you no need to be silent. I mean, if you have any questions, you just unmute and you can ask the questions. Let us look about the macroeconomic scenario. See, I mean, usually when we are talking about a macroeconomic scenario, usually this economic is around us. It is not about the inside the farm what is happening. It is the external, environment what is going to happen. Look at what are the current trends. If you see India and global, so in the global, slower growth in developed economies like US. I will just show you some data, and also I have shared the material that UI has taken a survey about the global geopolitical tension, or maybe their GDPs and their inflations, their employment status, unemployment status, all sort of things are basically covered in that report. So please go through the report to understand about the global economy a little bit more. So basically, overall, you can say that the global economy is going a little bit slower. And what about India? Yes, it is. We are absolutely in a resilience mode, and we have a strong GDP growth, which is about 6 to 7%. And the major strength is our digital economy expansion, particularly after using of UPI. So we are very strong in digital economy. In fact, you people, I mean, the participants will be surprised to know that India has surpassed, particularly the UPI, has surpassed the daily transactions to Visa. I mean, earlier Visa had the largest number of transactions per day, which just last month, UPI has surpassed. That means you people, you can imagine that where we are standing in terms of digital economy and how it is rapidly expanding. And just think about it that one day if we are just solving our cross-border payment problems, I mean where India will be. So that is one of the core strength of India, that digitally we are expanding, and of course rising middle class consumption. So as we just discussed a couple of minutes before, that middle class, particularly they are growing, their consumption is growing because of course they have a lot of aspirations and desire, so they are moving towards the consumption. So remember that if the consumption will increase, so definitely the demand will increase, right? And the demand will increase, so obviously the production will increase. If the production will increase, then obviously your employment will. So it's a kind of economic cycle. Try to understand that everything is depend on people's disposable income or on the consumption side. Then, of course, what about the market? So, market increased foreign capital flows, a lot of capital like FDI, foreign direct investments. They are coming and they are investing in our country. What else? We can see a lot of volatility in equity and currencies because of uncertainty, like a lot of war it is happening in the Middle East. or some of the countries, and of course, Trump is another side, who is also the reason of uncertainty. Uh, I mean, which is volatilizing the equity and currency markets. So further to dissect about macroeconomic scenario, so we have inflation, interest rate, and market volatility. All are pretty, not in a very stable conditions. But inflation trending above RBI comfort zone in certain sectors like food and fuel sectors. RBI is very, very stringent and they are making a very robust policy, like, balancing growth versus inflation. And all of us, we are experiencing that. That means interest rate is decreasing, RBI just to boost the economy. They're not disappointing. And even with cautious interest rate stance. I mean, it's not that it completely RBI is just, opening the hand and, increase the money supply. It's not like that. So it is, basically applying and adopting a balanced approach from the growth side and from the inflation side. Then, basically you can say that the global oil prices, right? So we have a very stringent global policies, and we are pretty comfortable about the global oil prices. Then always, there is a challenge basically in terms of US Fed policies and technological disruptions. I mean, because of AI. Uh, so usually you can find some tech disruptions at that. But always remember that this disruption is not going to harm anything. Rather, we have to wait a little bit to understand about what kind of opportunity AI is going to bring. So you might have, getting a panic sense that because of AI, people are losing jobs. A lot of core coding, employees or those who are having coding skills or something, they are losing jobs. But at the same time, you can see that there are a lot of jobs which have been created in terms of prompt engineering, and there are even many middle level of managers. They got some skill with AI and they leveraged their skills. So those kind of opportunity is also arising. So we should not completely disagree about these disruptions. Definitely, we have to hope for the best about the opportunity. So further to macroeconomic scenario, what are the impact on personal finance and retirement goals? Of course, inflation, as we discussed, that it will reduce the purchasing power, which need higher savings and inflation protected investments. So remember that if the inflation is a bigger concern, so we need to plan our investment. Otherwise, it will be very, very difficult because it may not beat the inflation. That means your money value will go down. So obviously, I mean, whatever the savings, it will be not worth as you are expecting. So that is a very, very important point. Okay? You need to understand about how to protect your investment from the inflation point of view. And interest rates, which affect your EMIs, loan affordability, and fixed income returns. Right? If the interest rate reduced, of course, you will be find it very sophisticated, or you find it easy because your EMI cost will be less. And fixed income returns, yes, definitely it will affect because you will get also a very, very little rate of interest when interest rate will goes down. So you need to plan accordingly where from which platform you can able to get a good return so that you can beat the inflations. So market volatility impacts short-term wealth but offers long-term opportunity also, right? So volatility market is basically it is for short-term, but those who are investors, they can stay for the long time and they can make money. So this is the picture what we can see in front of that is the developed market or developed economy like US. You can see 2023. So this is the real GDP growth. You can see 2.9% was the real GDP growth in 2023. In 2024, slightly gone down, and you can see 2025 the forecast is pretty below from the current. I mean the previous GDP growth. So what we were just talking about, discussion point just few minutes before that the economy is growing. I mean, slow. I mean, it is going to pretty slow. So this is what the picture in front of you. You can easily figure it out with in terms of GDP growth. And The forecast for 2026 uh, further worse than 2025. Whereas you can see in Canada the same situation, but UK they're trying to make it a balance. Euro area they have a prospect to grow the economy. Germany, so France, a lot of volatility. Spain, they're making a balanced kind of an approach. Australia. Let us see about I mean, is it Asian countries or even Middle East countries. So China, you can see that it is so it has a slow growth, but it is not drastically going slow. But India is maintaining a balanced approach. You can see that our forecast is basically 6.6 and 6.5 in between. So basically, the monetary policy or the fiscal policy they want to maintain within 6 to 7% of GDP growth rate. Whereas other countries like Brazil, ASEAN, basically these are association of Southeast Asian nations. These are so they are also approaching a balanced kind of approach. And MENA and SSA they have a growth strategy. So here is the inflation. You can see this consumer price index, and you can see that this is the global forecasting and the previous data. It is going down, and US making a very balanced approach in case of inflation. And India is also reducing its I mean, inflationary forecast. So this graph is giving us a lot of idea that which currency that people they are holding it. I mean, the official foreign exchange reserves. I mean, if the country they're holding more reserves, I mean, which currency they are holding? Of course, none other than US dollar. You can see this. The big portion is basically US dollar. That means most of the reserve banks they are holding US dollar as their reserve currencies. And then next to them is euro. Euro also is contributing a huge amount of reserve currencies. And you can find yen, this line, this is the gray line. And you can see the pound, which is in the green line. And you can see that after 2012, suddenly this like Canadian dollar and Australian dollar is also people are choosing as a reserve currencies. And you can see this yellow portions, which is started from 2016 onwards. It is also in a growing sense, that is Chinese renminbi. Okay, so these are the situations, these are the positions of foreign exchange reserves by the central banks. And this is the I mean the global data which has been surveyed by Australia. And this report I have already shared with you. For more details, you can please refer to the details. This is what central bank they are increasing and decreasing the rates. You can see that US I mean US or the Federal Reserve continuously decreasing the rate of interest. I mean, they are just planning to boost their economy, and US has a lot of disadvantages now, a lot of debt also. They're in the corner. So this is the scenario. You can see that US Federal Reserve how they are taking decisions about interest rates. Whereas India is, considering between 5.5, I mean 6.52, it has been reduced to 5.5. But next year we are projecting that it will be slightly, it will increase, but not much. So accordingly, we need to plan our investments. That interest rate is not going to budge or it is not going to very drastically high. It will maintain a range maybe between 5 to 6 or maybe 5 to 7%. So this is the scenario of employment. So you can see that US, this is the employment scenario. This is also, I mean, the projection is not very healthy. And here is India. India's obviously compared to last year, we are also facing a lot of challenges in case of employment. And here is Donald Trump's story that how Trump is just increasing the tariffs and policies. You can see this is a scenario of the entire globe on where US is putting tariffs. The highest tariffs is paid by Cambodia, 49%, and it is coming to India. But recently, they have increased to 50% on certain products, not all the products. You can see the list, the Singapore, UK, there, the tariffs is pretty less comparatively. And which sector usually highest FDIs are coming? These are all Asian countries, and you can see the financial services. All right. So the financial services, like this is the 2006 to 15. That means earlier it was there, and it went increased in 2016 to 24, and this is the projection what we are expecting 2025 to 2030, that we are expecting that most of the FDI they will flow into the financial services sector, like NBFCs, or maybe P2P lending, or maybe uh, you know healthcare financing or automobile financing. So any kind of insurance sector is also, so financial services sector is going to grow in the near term. I mean, no, not near term. I mean, the next, you can say that, around the 4 to 5 year scenario is this. And of course, the manufacturing is also a budge, you can see that, most of the FDI, they are willing to invest in the manufacturing sector, and comparatively, wholesale sector and real estate will be lesser. Okay, guys. So let us, go to the next, topic. That is, what are the investment instruments which is available in front of us? Okay. So before going deeply, so let me start a poll. Yeah, please. I hope the poll is visible. Yes. Excellent. Yeah, that's very interesting. Last five seconds. All right. Yeah. So this is for the result in front of you. And we can see that, the participants have given the answer diversely. That means, of course, people, they have their own preferences, their own choices. Equity stocks, I mean, almost 25%. Mutual funds, around, 50% participants, they chosen mutual funds. Then fixed deposit 13%, gold 38%, nice, and real estate around 63%, cool, nice, and digital assets, 25%. Very good. Very good. I mean, you could choose, multiple also. I mean, if you want to invest, two or three, also you can answer. That's not a problem. So, okay, let us, discuss one by one, little bit deeper, need to understand that, what could be the advantage and what could be the disadvantages in these investment options. Okay. So first of all, most of you are so fascinated about equity, right? So equity, which is usually we call shares, direct stocks, equity mutual funds, all are, basically we can call them equity. So equity is basically we can, it's a kind of investment or instrument which is a little bit, higher risk than, comparatively the other investment instruments. right? What kind of risk it is available, that we will learn a little bit when we will talk about risk versus return. So and usually let me tell you from the beginning that risk and return are highly correlated. The more risk you want to take, the more return you will get. Just like take an example that if you don't want to take any risk, so better you can invest in fixed deposits, because you can see this debt funds. So debt funds are basically they are riskless or risk-free assets. So you don't have to take any kind of tension. You just invest in debt fund like bonds, debentures, mutual fund, even fixed deposits are also fine. Because in India, I mean, our banks are pretty healthy. You can trust on the banks. So what the benefit in investing in debt? Basically, you don't have to take any tension, and whatever the committed return, you will get it at the end of the period. So that advantage you have in case of debt investment. But in case of equity, in the debt case, what happened? You didn't take any risk, and the return what they were promised, it is comparatively lower than other investment instruments. But equity, at the same time, uh, there is a risk involved. What type of risk involved? There is, business risk, right? The business risk means you can understand that the business, if it will not, perform well, then it's a problem. Your value will go down. You may not get return. The business is not earning. If the business is not, making profit, that kind of risk also you are taking. So because of that, the risk involved or associated with equity is pretty high, right? So, in other way, you can say that the risk and return are highly correlated. The more risk you want to take, the more return you can expect. You can expect, and there's no guarantee. Try to understand. So, people, if they are thinking that if I'll take high risk, I will get high return, absolutely, this is wrong. Okay, so you can expect always. You can anticipate, right? Otherwise, everybody will buy lottery, right? Lottery, what happens? You need to invest, let's say, by paying 10 rupees, and you can only expect that you can be the winner and you will get 1 rupee, right? So that expectation is there, but look at the probability. How much risk you are taking? 0.0000. I mean, the probability is pretty less to winning a lottery, right? So those kind of things you need to assess. So always remember one fact or one thing, that the risk is always associated with the return, right? You can't tell that I'm just uh, expect a higher return without taking risk. That is not possible. If somebody will come tomorrow, a phone call will come. Hey, I mean, you just invest here. 25 दिन में पैसा double. I mean, in 25 days, I will make double your money. And you think you'll be surprised. I mean, oh my God, this guy is offering me the best thing in the world, and let me invest. And after that, 25 days will never come, right? Neither you will get your capital back. So this kind of understanding you should have, uh, that how the risk is associated with the investment. So similarly, gold is always, it's a safe haven, safer assets, but there are a lot of, cons out there. Cons means, holding is not that great idea, because you will invite some kind of, troubles also. So it's better if you can hold some of the, digital gold, like in terms of, bond, digital gold bond or sovereign gold bonds, which is issued by our government of India. Mutual fund, most of the students, they or the participants, they have chosen mutual funds. And why it is one of the popular among particularly youths like you, if you want to start investing, so mutual fund is one of the best investment, I would say, because you don't have to take much risk. There is a fund manager who is going to manage your fund on behalf of you. So you just have to decide that which kind of thematic area you want to invest. So those kind of exercise you have to look at. I mean, if you have a little bit idea about the industry or macroeconomic factors, just like how we analyze that, let's say a lot of FDI is coming in terms of financial services sector. So if any kind of idea it is coming, that you can choose a mutual fund which is investing more into financial services, so probably that would be the best idea. And the mutual fund manager, he will take all the care of managing the fund on behalf of you. So that's the reason why. most of the participants, they are fond of starting a mutual funds. And ETFs are very similar. I mean, they are traded in the markets. That's called exchange traded fund. Like they are also low cost, passive index, tracking. I mean, you can purchase the index also through ETFs. Then PPF, we already discussed about public provident fund. It's a long-term government-backed savings scheme, usually 15 years lock-in period. You can't, withdraw the money before 15 years. Then you can also apply for another subsequent 5 years, and it is tax-free. Okay, and pension-focused investment is NPS, mix of equity and debt. So you can choose in NPS, who are the fund manager, maybe LIC or UTI or whoever is, and accordingly you can allocate your funds so that they will manage. So it is a kind of a mix of equity and debt. This is also a pretty good investment option, and it has given a good return also in the past 4 to 5 years. The real estate investment trust or invest ITs, like infrastructure investment vehicles. So these are also, good investment vehicles. But as we saw that because of the degrowth nature of real estate market, you have to be little cautious. You should not be aggressive to put money into real estate sector. It's not that actually real estate also, when we are talking about REIT or real estate investment, there are two different things. So usually REIT, those who are real estate investment trusts, usually they invest in the metros. So when they invest in metros, so you need to understand, which are the places they are investing, like in Bangalore or Delhi or Mumbai, which area. So always remember that, real estate, some places it might be, saturated, the growth might have saturated, and some places still there is a growth opportunities there. If the investment is related to a place where a lot of growth opportunities is there, so definitely you should go for real estate investment. Otherwise, if you find that, let's say, let me give an example that, let's say about in Bangalore, there are places where, usually there are a lot of inventories out there. I mean, many builders, they have already started constructed their apartments, but still they're unsold. So if uh, the flats have constructed and they're unsold, what the builder will do? The builder will decrease the price to just to get away with the inventories, get away with the stocks. So usually what happens, suppose let's say 1.5 crore house, probably they will offer you in 1.2 crore or 1.3 crore. So what will happen actually, the growth opportunity, you always need to look at, whether it has a growth opportunity or not. But at the same time, if you can just buy a land at a village area or where is in a township or something, and if you think that the town is going to be a smart city or something in the future, so probably your value will increase much better than compared to metros. So that kind of analysis you have to do. So a little bit idea also I would like to try to give it to you about traditional modern instruments, like traditionals are fixed deposits, RDs, LIC policies, PPF, all this. And moderns are basically systematic investment plans. That means systematic investment plan is nothing. You have to choose a fixed amount of money, which automatically it will deduct from your bank account. But the good thing about mutual fund systematic investment plan is it is a kind of recurring deposits kind of. You can withdraw also whenever it is required in case of emergencies or something. But it is not advisable to withdraw. The LIC policies or maybe digital assets, you can invest in digital assets like cryptos or tokenization securities, and you can make a blended approach like stability plus growth. Here, some tax. Let me just throw a little bit tax here. That means if you are investing in equity, remember that there is some tax. You are inviting certain things like SPC, short-term capital gains. If you are holding less than 1 year, you have to pay 15%. If there's a long-term capital gains more than 1 year you are holding, then LTCG you are attracting and you have to pay 10%. If it is, more than 1 lakh. Then gold, of course. If it is physical, then LTCG 20% with indexation. Okay, you'll get the indexation benefits. PPF Exempt, exempt, exempt. That means contribution is exempt, interest is exempt, and maturity is also all tax. Then tax benefit under Section 80 CCT up to 50,000 or the NPS you will get. Here is a brief, you can see the comparison between different asset class. These are the instruments, and you can see these are the returns you can expect. Okay, you don't, I mean, you can't even expect more than this. If it is coming, it's well and good. And the risk also associated with this, like equity, the risk is pretty high, whereas mutual fund, it is medium to high. If you are taking, let's say you are investing in a fully, equity fund, so the risk will be high. And debt is low to medium. FDs are pretty low, right? PPF is very low. NPS is moderate. Then gold is moderate. REIT is moderate, and digital assets are very high because of volatility in nature. And these are the lock-in periods, and you can see these are the taxes. So let us talk a little bit about risk versus return. What happened? You need to understand always that the risk spectrum, how the risk is being associated with your investment. Like as we discussed, that there are low risk instruments are there, like FDs. You need to categorize it like this. How I have done it, so you can categorize that these are the low risk instruments like FDs, PPF, government bonds, which will give you a stable and low returns, like 5 to 7%, not more than that at this current scenario. Whereas as a medium risk instruments like you have debt, mutual funds, NPS, gold, or balance fund, that will give you 6 to 9%. And also you have high risk instrument like equity mutual funds, the REIT, digital assets, which will give you 10 to 15%, sometimes more than that, right? So if you can, bifurcate or you can make groupies in, so it will be very, very, it will be helpful for you to make an investment because your portfolio should construct according to the risk basis. Okay, so how much you are basically investing in low risk products, how much you have invested in medium risk, and how much you have, invested in high risk. So overall, you can get a very, enthusiastic return. I mean, you always need to act as a balancing with diversification when you are diversing your money. Like, you need to spread the investment across asset classes like equity, debt, gold, real estate, balance risk appetite, like, plus, financial goals, plus time horizon. The three things you need to always, you have to give emphasis, risk appetite, how much risk you can take. So remember, guys, I mean, basically, you always take risk according to your age. Okay, if you are young, you are new to the job, you can take a slightly, more risk comparatively if you are in your 40s or 50s. So that things you should not forget. I mean, don't jump just at the age of 40 or 50. I mean, just to expecting with a higher rate of return or something. So this is very, very important. Then example allocation, like like those who are aspiring higher, 60% at this point of time you can invest in equity, 30% you can invest in debt, and 10% you can invest in gold or REITs. This is the current advice I can say. Particularly, most of our participants are pretty young. You are yet to go to job market. If you are going to the job market, so don't forget this rule 60-30-10. So this could be your asset allocation for the time being. So this is just a scenario. I mean, you just see that if you invest 1 lakh, so how, I mean, which instrument is going to give you how much return? If it is, let's say equity, and the Sensex is going to give you around, let's say, uh, I mean, 10 to 15%. So your 1 lakh invested will be 9.6 lakh rupees, and gold will give you 4.6, and PPF will give you 3.9. So just see that. I mean, if you are just investing 1 lakh rupees, I mean, around 20 lakhs, near to 20 lakhs rupees, you can easily get it if you make a proper mixture of asset allocation, and which you can see that it's a pretty minimum. I mean, the risk is also not very high, but you can say that the return is also not very high, but it's moderate, but you are safe. You are not losing your capital. Okay, so quickly, let us go to the concept of compounding and SIP growth. Let me quickly share that how you can make a plan of getting 1 crore rupees. Guys, this is the hand-on exercise we will do. You have to open your Excel sheet. Let me just little bit zoom it. And one financial formula you always have to keep in your mind. Okay. The first thing is that FB is the formula, right? So suppose let's say your target is 1 crore, right? Yeah. So this is 1 crore. So this is what you're supposed, let's say, your target, right? So if your target that you are going to accumulate this 1 crore rupees at the point of maybe after 20 years, or you can say that is your retirement goal. So probably how can you achieve it? That is the biggest question. How to make a plan? Let us design a model so that it will give you a lot of ideas. Okay, as I mentioned that you have to invest in three different instruments, right? First of all, equity, right? Then I also asked about certain kind of you can invest in debt, right? So debt means probably fixed deposits or bonds or something, and 10% in rates. Okay, so let us see that. This is the debt instruments, and this is maybe you can consider as gold or ETF, whatever it is. A REIT or gold, you can invest. As I mentioned, that this would be 60%, 30%, 10%. Right? This is your asset allocation for your investment plan. So if this is the allocation, so what happens if I will just calculate that how much I require, right, after maybe 20 years? Then I can expect that after 20 years I will get this much of amount, right? Am I correct, guys? So this is what I'm going to get after 20 years period, right? So what I will do, I will calculate a backward calculations, right? This is what my objective, that let's say this is 2025. If I'm going to the job market in 2026, maybe 2045, this is my target. Okay, so that means you can say that it's 20 years goal. After 20 years, you want to make that at least in your bank account 1 crore rupees would be there. That means in 20 years, you can expect that these are your asset class, it would be there. Then what would be the value today? Okay, so now what happened? We have to calculate differently. If suppose your expected return in equity is, let's say, around, I'm just taking a very moderate one. This is 12%. All right, and debt is, let's say, around 9% debt, and the gold will, let's say, gold will definitely, it is nowadays it's giving bigger, and gold, let's say, it's giving around 8%. Okay. So let me see that what is the present value of today. That means if you want to invest, so how much? So you can use this formula called PV. This is the rate, right? I mean, I'm just, calculating annual compounding. So you will get sometimes, monthly compounding or quarterly compounding, that we will see it in a while. So N4 is 20. There is no PMT. Then there is future value. Okay. So you have to invest this much today so that you can get this much at this time, right? So after 20 years, you can make a corpus if you are investing in equity 6 lakhs 22,000 or in debt 5 lakh 35,000 and in gold 2 lakh 14,000. But guys, I mean, look at how much you need to invest. So around 13.71 lakhs if you are investing. So after 20 years, you'll have 1 crore rupees. But this is not the case. I mean, this is just an expectation with the minimum. It's a bare minimum expectation. And in equity market, usually you can find, the stocks are giving sometimes 15, 16%. If just, it is giving somehow it is 15%, you don't need, invest that much of amount. Only 10 lakh rupees if you are investing today, so you can easily achieve your target after 20 years. And just think about it. I mean, after 20 years, I mean, if you are having, 1 crore rupees as a corpus, so it's absolutely fantastic, right? I mean, all sort of things what we have learned so far, it is going to help you. Okay, so we are almost close to the timings. So let me quickly cover whatever the remaining things. So demonstrate with a simple calculation like SIP. Okay, so how much you can do it like monthly. Also, at the same time, you can make a smart goals for your financial independence. What is a smart goal? So money makes money, right? When you invest 10 lakh rupees and you know that how it is going to increase and it is going to achieve 1 crore rupees at a point of time. And the money that makes more money, right? So always you have to think about it and then early start, longer compounding period, right? So the much like in Warren Buffett or most of the financial or investment or rich people, they have started at a very early stage of investment. SIP is always it is going to help to build your wealth with discipline because it's a monthly and fixed. I mean, it will help you a lot. Okay, so 1 crore goal, some of the more prominent things which we have given here. SIP, if you can do 15,000 per month at the rate 12% CAGR, 1 crore in 20 years. That's it. All right. Or if somebody is getting, let's say, around a package of 70, 80,000 per month, easily you can make an SIP in 35,000. If it is giving annually 12%, 1 crore you can achieve in 10 years. Lump sum, what we just saw, 10 lakh, 12% CAGR, 1 crore in 20 years. So, I mean, this is one of the, things which you need to plan. You can model in Excel and accordingly you have to take it. And what I told you in this webinar that you should not forget a couple of things like the risk is always associated with the return. You should not forget it. What is a smart financial goal? You can make the smart financial goal like specific, like defined exact amount. If it is not 1 crore, then how much it is? You can also plan for 2 crore, 5 crore. It depends on your pay package. Then it should be measurable. That means you need to track via SIP calculator or app because most of the apps are now it is giving you those kind of flexibility to understand how your return is. I mean, you are earning how much return. Achievable, it should be achievable, like aligned with lifestyle and risk appetite. Don't go for a high risk like don't go for a Dream 11 or something. Put money and don't expect that overnight you are good. There is no shortcut of earning money overnight. Okay, you have to hold a lot of patience and you have to wait and you have to strictly follow the rules. Then only you can achieve your goal. And this is called financial discipline. So financial independence uh, can be achievable through financial discipline. Then it should be time bound. That always you have to fix a deadline. I mean, how many years I'm going to make how much money. So wealth creation and retirement planning, that as we discussed, that is you have to stick to the asset allocation. Okay, because as we discussed that it is diversifying your risk, and remember that you need to avoid certain things like lifestyle inflation and unnecessary debt. My suggestion is always to my participants or friend that avoid the debt as much as possible. Do not go for a loan to buy a house. Do not go for a loan to buy a car. Maybe you can see that you can argue that sir, I'm young. I just have aspiration. I just want to drive a car. But always remember that if you want to acquire those things, then you are sacrificing a lot of. You are sacrificing financial independence, and you have to always you have to be calm and you have to control yourself. And this particularly lifestyle, I mean expensive things or maybe expensive cars or I mean even you can choose to rent an apartment rather than buying it, right? But always remember that avoid the loan or debt as maximum as possible unless until you are I mean there is no other choice, there is no other way. Don't go for it. So that's my advice. Variations in the fire movement, like lean fire, like you have to minimize your lifestyle, low expense, so that you can achieve your target. Fat fire, you just work, I mean hard, you earn more money, you have a luxurious lifestyle, higher purpose you also require. Barista fire, like partial retirement, side income, you can retire early, then you are not fully engaged, but you can do some part-time jobs, freelancing, so that you can manage your life. So this is a 4% rule, which is global. Withdraw 4% annually from your retirement purpose, whatever the rest of your period. Then Indian context, because we have higher inflation, so safe withdrawal rate is 3 to 3.5%. So example, annual need is 6 lakh rupees. So corpus is required 2 crore rupees. All right. So if you need 6 lakhs rupees as a retirement, uh, money or monthly, you know, earnings, 50,000 rupees you need your monthly expenditures or something, you should have a corpus of 2 crore rupees where you can make 3% return. Also, guys, this is the last topic. I would mention that role of passive income. Don't forget this. That means when you are investing in equity, try to choose a dividend, paid equity stocks. Most of the PSUs they pay very nice dividends along with a good capital gains. Don't forget about that. And rental income, if you are investing in real estate, you will get rental income. These are all called passive income. That is, these are not active income. You may, work and you may get salary, and your investment is also giving you some kind of return. So side hustles, digital income streams. Goal is what? To reduce dependence on active salary. So your dependence on active salary will go down. Then probably you can move towards financial freedom. Okay, so this is what for today. So please, I'm opening this for questions. You can unmute your mic and you can speak.